Hello, I'm Professor Brian Bushee. Welcome back. This video kicks off our look at shareholders' equity, which is the last stop on the balance sheet. In this video, we're going to talk about share issuances, the difference between common and preferred stock, and share repurchases. Let's get started.
So as we talked about in the first week, shareholders' equity is the residual claim on assets after settling the claims of your creditors. In other words, assets minus liabilities. So this notion that if you measure your assets correctly and your liabilities correctly, shareholders' equity is what's left over. But we saw that it came from two different sources. One was share issuance. So you could have contributed capital where you go out and raise funds through common stock or preferred stock. And then we'll introduce this concept of treasury stock, which are repurchase shares, shares that the company buys back that may be reissued to the public at any point. And then stockholders' equity or shareholders' equity can come due to operations. So we have retained earnings, which we've talked about a lot in the course, where we have your beginning retained earnings goes up by net income, goes down when you pay dividends, and that gives you the ending retained earnings. So retained earnings is literally net income that you have retained that you've not paid out as dividends. And then we talked about briefly accumulated other comprehensive income. This functions sort of like retained earnings, except for its items that bypass the income statement.
I would very much appreciate it if you could elucidate the differences between stockholders' equity, shareholders' equity, owners' equity, and just plain equity. I have been avidly watching the videos these past weeks, and I have heard mention of each of these terms.
Good question. The terms stockholders' equity, shareholders' equity, owner's equity, just plain equity all mean the same thing. You see stockholders' equity and shareholders' equity most common, and I'll tend to use those terms interchangeably both on the slides and when I talk about the slides.
So let's talk about the two types of stock that companies issue. So there's preferred stock, which is between debt holders and common stocks in claims on assets. So what that means is if there was a bankruptcy, the company had to liquidate all its assets to give to its creditors and owners. The debt holders would get first claim on the assets, whatever's left over. Then the preferred stockholders would come in, and then the common stockholders would come in last. Preferred stock doesn't have any voting rights, so they can't vote on the board of directors, but they are entitled to a fixed dividend that has to be paid before any common dividends are paid. And it oftentimes has some kind of feature like it's callable or convertible or redeemable. Callable means that the company could buy it back at the company's option. Convertible means that the holder can convert it into common stock. Redeemable means the holder could make the company buy it back. So this preferred stock is this sort of weird way station kind of instrument sort of between debt and between equity that can oftentimes be turned into common equity or just be taken out by the company if need be. Common stock has all the voting rights, so they get to vote on who the board of directors will be, but they're the last claimant on assets, so they have the biggest risk of loss in a bankruptcy, but then they often get the biggest return if the company does well. Par value, as we've talked about before in the course, that's the stated value on the shares that's used to compute the balance in common stock or preferred stock. Historically, par value had a meaning, but nowadays it's somewhat arbitrary. And it's really just there to give accountants an extra thing to teach. And then, of course, additional paid-in capital, or APIC, records all of the amounts received when you issue stock that come in excess of the par value.
I would prefer preferred stock if it had no par value, but who else would want preferred stock?
I agree that preferred stock is this weird combination of debt and common stock. And I think one of the reasons that investors like preferred stock is that some investors really like dividends. And with preferred stock, you get a guaranteed dividend, or at least guaranteed in that they can't pay common dividends until they pay all the preferred dividends. And in some countries like the US, dividend income is taxed at a lower rate than interest income, like if you bought a bond. Also, preferred stock is like a way to get your feet wet or dip your toe in the water with a company, where because of these call features and redeemable features, you can go in to get preferred stock. You take a little bit more risk than a bond, but you have the option oftentimes to convert that to common stock if you think the company's doing well. And if you don't think the company's doing well, then you can basically redeem it and get out of the company fairly easily. So it's a way to sort of get into the company's equity without diving in full, taking the full risks of common stock.
There's some key terminology that we have to keep track of when we're looking at contributed capital like common stock and preferred stock. First term is shares authorized. These are the total number of shares that the firm could issue. This is often determined in the corporate charter or by the board of directors, and it doesn't mean a lot. It just means that the management could go out and issue new shares up to this limit, and then they'd have to go and try to get permission to issue more shares. A more important number is shares issued. These are the number of shares that have been sold to the public at one point or another. And when you look at the balance in common stock par, it's based on this amount. So if you took par value times the number of shares issued, it should equal the balance in common stock par. Another key term is shares outstanding. These are the number of shares that are currently held by the public. How can that be different than shares issued? Well, it's because companies buy back their stocks in these treasury shares. So shares outstanding equals the shares issued minus the treasury shares, minus the shares the company has bought back over time. The dividend payments and numbers like earnings per share are based on this amount. So dividends are paid to shares outstanding. And when you see earnings per share reported, which we'll talk about later, that's based on the shares outstanding.
Seriously? Are you just going to define terms this whole video? I could just read Wikipedia if that is the case. How about adding some value by doing an extended example?
Good point. Enough definition of terminology. Let's dive in and do an example.
So let's start the example. So first of all, we've got on January 14th, 2012, Stack Incorporated issues 10,000 shares of no par preferred stock for proceeds of $7 per share. The preferred stock specifies cumulative $1 annual dividends per share. So let's try to do the journal entry to record issuing the stock, and I'll go ahead and throw up the pause sign so you can try to do this one. Okay, so we're going to have a debit to cash for $70,000. We're issuing 10,000 shares, $7 per share. That's $70,000 cash we're receiving. We're going to credit preferred stock for $70,000. All of the contributed capital goes into preferred stock because it was no par. So there's nothing that goes into additional paid-in capital in this case. But by assumption, when it's no par, everything goes into preferred stock. And we also don't do anything with the dividends at this point. We don't do anything until the dividends are declared, which they will be later as we go through the example.
The tailors, I love this preferred stock, but what is this cumulative dividend?
The cumulative dividend is basically a promise by the company that if they're going to pay any dividends at all, preferred stockholders are definitely going to get their $1 per year. So where this would come into play is, let's say a company got into a cash crunch. They couldn't pay dividends, so they skip preferred dividends for a year. They owe those preferred dividend shareholders at least $1 per share. Now let's say they couldn't pay the next year. Now they owe those preferred stockholders $2 of dividends. Before the company could pay any common stock dividends, they have to go back and pay the $2 of cumulative dividends that they've missed. So what happens is if a company misses preferred dividends, they add up, they accumulate, and before the company can pay any common dividends, they have to pay all those accumulated dividends on the preferred stock.
Now let's take a look at the example where we're going to raise common stock, which is, of course, a review of what we did much earlier in the course. So on January 14, 2012, Stack Incorporated issues 12,000 shares of $1 par value stock for proceeds of $10 per share. So I'll go ahead and throw up the pause sign, and you can try to do this. So we're going to debit cash for $120,000. That's the 12,000 shares times the $10 of share that we get as proceeds. Credit common stock for the par value. So that's 12,000 shares, $1 per share. Par value is $12,000. And then everything else goes into additional paid-in capital, or APIC, $108,000. That's the additional proceeds beyond the par value. Now, one thing that we're going to keep track of with this example is the number of shares issued and the number of shares outstanding, which are both 12,000 in this case, but we'll need to know these figures later on. Next thing we're going to talk about is share repurchases and this account called treasury stock. So companies sometimes repurchase their own shares. These repurchased shares are carried in the treasury stock account, which is a contra shareholders' equity. So XSE stands for contra shareholders' equity. That means it goes up with a debit and down with a credit balance. So just the opposite of the way stockholders' equity normally works. Treasury stock does not have any voting rights or dividends rights, which makes sense. We wouldn't want the company voting on its own board of directors. And treasury stock can be reissued by the firm at any point. Reissued means sold back to the public. The reissued treasury stock will come out of the treasury stock account at its original price. So if you repurchased at $11, when we take it out, we're going to bring it out at $11. And then APIC, or in some cases retained earnings, is used to balance the journal entry if we resell it for a price that differs from what we bought it. So if we bought it at 11 but then resell it at 13, we need to do something with that extra $2. It's going to go into APIC or retained earnings because companies cannot book gains or losses trading in their own stock.
I am a bit flamboozled as to why a company would repurchase its own shares.
Seriously. Does a company also loan itself money and hire itself to work for itself?
So there are four big reasons why a company would repurchase its own shares. The first one is they may have excess cash. And instead of paying that cash out as a dividend, which could have some problems that we'll talk about later, they decide to just buy back their shares, basically give the excess cash to any shareholders that want to get out of their investment or cash out. Second reason is the company may think their stock price is undervalued. And while you could talk to analysts or investors or go on TV and talk about how your stock is underpriced, a way to put your money where your mouth is, a costly signal, would be to go back and buy your shares because you think they're underpriced. The third reason, and this is one of the big reasons nowadays, is you buy back shares to sell to employees under employee stock option plans. And we'll talk about that later in the week. And the fourth reason is you may think that you're under leveraged as a company. So you borrow some money, use the proceeds to buy back stock to increase your leverage, increase your debt to equity ratio, which would then increase your ROE, maybe give you some more returns to leverage. So those are the four big reasons. But the big one I think nowadays is buying back shares to use for employee stock options, which, as I mentioned, we'll talk about later in the week.
So now let's go back to our example and look at how treasury stock would be purchased. So on March 3rd, 2012, Stack Incorporated repurchases 4,000 shares of its common stock at a price of $11 per share. I will throw up the pause sign and you can give this one a chance. Okay, so we're paying cash $44,000. So I have a credit to cash $44,000. That's 4,000 shares times $11 per share. The debit is going to be this account treasury stock, which is a contra shareholders equity, which means it's increased with a debit, and it goes in at 44,000, which is the 4,000 shares times $11 per share. Now this doesn't affect our number of shares issued, which stay at 12,000. But our number of shares outstanding drops to 8,000 by bringing these 4,000 shares into the treasury. There's now only 8,000 shares that are outstanding among the public. Now let's sell some of this treasury stock. And first, we'll look at what happens when there's a price increase. On April 4th, 2012, Stack Incorporated sold 1,000 shares of its treasury stock at a price of $14 per share. So this one's hard, but I'll put up the pause sign if you want to try to do the journal entry. So we want to debit cash for $14,000 because we're receiving $14,000 cash. That's 1,000 shares at $14 per share. We're going to credit treasury stock to reduce the treasury stock for $11,000. Remember, that's the original cost that we bought shares at $11 a piece. So 1,000 shares times $11 gives us the $11,000 that we take out of treasury stock. And then we're going to plug additional paid-in capital. So additional paid-in capital is going to increase by $3,000, and it's going to do that simply because we cannot book a gain on this sale because it's transaction on stock. Got to put it somewhere, so we put it into additional paid-in capital. Our shares issued remain at 12,000. Our shares outstanding now increase to 9,000 because we've reissued 1,000 shares to the public. The public now holds 9,000. We still have 3,000 shares in treasury.
Why would the company not be enabled to record a gain in this transaction? They bought low, sold high, and should get credit for a gain. No pun intended.
No pun intended? Oh, credit for a gain. A gain is a credit. Good one. So there's a couple reasons why we don't allow companies to book gains or losses on transactions in their own stock in the income statement. First is these stock transactions have nothing to do with operating the company. So what we want on the income statement is revenues and expenses that apply to running the business. Buying and selling your stock doesn't have anything to do with your business. It's not your core operations. And the second reason is that these stock transactions are easily manipulable by companies. So it would be very easy for a company to book a gain trading in its own stock. All the company would have to do is come out with some pessimistic news, some bad forecasts, the stock price would go down, the company buys it. Then a month or two later, come out with some good news, a good forecast, stock price goes up, they sell it. If we let them book a gain on that, that's not very high quality earnings because managers have a lot of control over the timing of that gain. So we don't want to have that kind of potential abuse. So any kind of stock transactions where companies have superior information, we keep off of the income statement.
Next, let's look at an example of selling treasury stock when the price has gone down relative to when we originally bought it. So on May 5th, 2012, Stack Incorporated sold 1,000 shares of its treasury stock at a price of only $9 per share. Remember, it originally bought it at $11. So I'll go ahead and put up the pause sign and see if you can do the journal entry here. So in the journal entry, we debit cash for $9,000 because we're receiving $9 per share for 1,000 shares, so that's $9,000 cash. We credit treasury stock. We remove it from the contra shareholders equity account at the original cost, which is $11 per share, or $11,000. Now we need a plug to a debit, so we debit additional paid in capital, reduce the APIC account by $2,000. That's the plug. We need that because we can't recognize a loss in this case. Now our shares issued, again, still 12,000. Our shares outstanding have gone up to 10,000 because we've reissued another 1,000 shares to the public. We still have 2,000 shares in treasury. One more note, we reduced APIC. If APIC had a zero balance, additional paid in capital can't go negative. So if APIC had gotten down to zero, then you'd have to switch the debit to retained earnings instead, which is not a problem because retained earnings can have either a debit or a credit balance.
Seriously? How could a company ever have a balance of zero in APIC? And what if retained earnings was zero?
Actually, it's becoming more and more commonplace that companies' APIC is going down to zero and they're having to go to a debit to retained earnings in this kind of journal entry. And again, it's because of these employee stock options, which we'll talk about later in the week. Just as a preview, anytime an employee exercises a stock option and we use treasury stock to deliver the stock to them, they're paying less cash than what we bought the treasury stock for. And so we get this debit to APIC. And so there's companies which have gone through all their APIC. APIC can't go negative, so it stops at a zero balance, and then we start to debit retained earnings. And for a lot of companies that do a lot of stock options, their retained earnings actually go negative as it can and becomes accumulated deficit. And in this case, the accumulated deficit is not bad news. It's not that their operations have been cumulatively unprofitable. It's actually good news. It means that their stock price has been going up. They've been giving a lot of options. The options have been exercised, and it's just eating into this APIC and retained earnings. So it's a weird feature of this stock-based compensation that we're seeing nowadays that you actually see a lot of these debits to APIC and then debits to retained earnings, and oftentimes negative retained earnings due to these employee stock options, which I don't know if I mentioned. We'll talk about later in the week.
There's one more treasury stock transaction we're going to look at, and that's treasury stock retirement. Now, retirement means that we're going to destroy the shares. We're going to permanently retire them so that they can never be reissued, and they'll be taken out of shares issued count. So these shares are gone for good. So on May 15th, 2012, Stack Incorporated decided to retire 1,000 shares of its treasury stock. So I'll put up the pause sign and you can try this journal entry, but this one is pretty challenging. So the journal entry, we'll start with the credit to treasury stock. So we're taking that 1,000 shares of treasury stock, we're taking it out of the account at its original cost, which again is the $11 times 1,000 shares. Since the shares are being retired, being destroyed, we want to get rid of the balance in common stock. So we're going to reduce that by 1,000 shares times the $1 par value. And then we'll take the rest of this out of additional paid-in capital to plug. So it's the exact opposite of issuing a share where you create common stock and create APIC. When you retire a share, you remove the common stock, you remove the APIC. So now our shares issued balance drops from 12,000 to 11,000. So those shares are gone. Those 1,000 shares can never be reissued. And what it's going to happen is now our balance in common stock par is going to be $11,000, the 11,000 shares issued times $1 par value. Our shares outstanding are not affected because this transaction didn't affect the amount of shares held by the public. So we have 11,000 shares issued, 1,000 shares still left in treasury after we destroyed this 1,000, which means that we still have 10,000 shares outstanding.
Goodbye common stock. Goodbye par value. I love this retirement transaction, but why do it?
Yeah, the stock retirement transaction is not that common. Most of the time when companies buy back their own treasury stock, they intend to either reissue it or they hold on to it so they have the option to reissue it, sell it back to the market at some point. The only time I've actually seen this retirement transaction practice is when there's some kind of hostile battle between management and shareholders, or where management's trying to take over the company. And so they're buying back shares to try to prevent them from falling into the wrong hands or increase their own ownership. And they basically destroy the shares to make it more costly to have them reissued later. But other than these really hostile battles, I haven't seen that many instances where companies retire their stock. But just because it doesn't happen that often in the real world doesn't mean that I can't show you the journal entry, so at least you know it in case you ever run into it. That's not the most compelling motivation to keep watching these videos, to continue to learn things that don't actually happen in the real world. Well, don't worry. In the next video, we're going to talk about retained earnings, which will get us into dividends, both cash and stock splits, and a little bit of AOCI. So I promise you the stuff in the next video will all be relevant to what happens in the real world. I'll see you then.
See you next video.